Hello, my name is Russell Myers. Welcome to Issues Unite. So, Morgan Stanley has published a report which is stating two things. One is that since early 2022, when the Federal Reserve began increasing interest rates, that over $1 trillion have been withdrawn from the banking system. Now, this goes right along with things that I have talked about before, that consumer credit is at the lowest point that has ever been recorded, including during the Great Depression. So it had gone way up in 2020, but but now more and more money is just being withdrawn from the banking system. And there are also lots of reports that are out, not in this one, but, lots of reports coming out that precious metals, especially gold sales, have skyrocketed. So the other thing that this report says is that credit availability is constricting. Banks are not loaning out money. And this is something very worrisome. You don't have to be looking to gain credit, take out a loan or a credit card or buy a car or a mortgage. You don't have to be doing any of that for this to affect you. What this means is that the economy itself is contracting. So you think about this, businesses have to have credit, especially small businesses. If you have, especially, a cyclical business, like construction, which tends to be very seasonal, landscaping businesses, a lot of restaurants have that. They're very seasonal. Bed and breakfasts, small bed and breakfasts that are family owned and so forth and so on. They need credit quite often to expand or even just maintain their supply systems. They don't have to be trying to expand their business, but they need credit for their supply chain, for repairs, etc. So this is going to lead to further inflation. If a business is unable to obtain credit through your standard banking system and so forth, which most small businesses rely on local regional banks, by the way, that are seeing the greatest outflow of deposits. If they're not able to take out a loan from your standard banks, credit unions, etc., then they're going to go to secondary lenders that charge much higher rates of interest. And these businesses, small businesses, don't have a choice but to pass along those expenses. Basically, the reduction in credit won't really affect the large businesses nearly as much as it will affect small businesses. But even the large businesses, if they're paying more interest and having a more difficulty obtaining credit, then they're going to pass that expense on to you, and they're also going to be laying people off, which, by the way, new unemployment claims are on the rise again. This is in spite of the fact that the Department of Labor has admittedly, openly stated that they have changed the way that they are calculating unemployment and also how they calculate the labor participation rate. They've made alterations to these calculations to try and make it look better than it is. So this is all aside from the fact that many times people become unemployed and they don't file with their state for unemployment benefits. When you're talking about the unemployment rate that is being reported, well, that is all depending on what gets reported. There have been a number of times that I was unemployed or underemployed, and I did not file for any benefits with the state because I didn't expect either the circumstances made me think that I would not be eligible, or I didn't think that I would be unemployed long enough to even get those benefits. In most cases, I was correct. But a lot of people do that. Just because you get laid off, fired, quit, whatever, if you don't file with your state Department of Labor, then they don't report to the federal government. Depending on what state you live in, many people, even if they feel they are eligible for unemployment benefits, they're not going to bother trying to get those benefits because those states are most likely to refuse the request. Yeah, there are a number of red states that, including Alabama, that they do everything they can to deny a request for unemployment. So those states have fewer people that ever apply, so it never gets reported to the federal government. So it makes it look like those states have a lower unemployment rate than they actually have, aside from the fact that they don't have to pay out any benefits, and so forth and so on. Now, any one of these things taken individually tend to be a negative sign. But when you put them all together, they absolutely indicate that we are going headlong into a recession. All of this with the credit, this is one of the signs of a recession. Banks aren't loaning out. They're building up their own reserves in case people make a run on the bank. If more and more people are withdrawing money, including putting money into money market accounts, money market funds. Usually the money market accounts are not counted as deposits in the bank. Money market funds are managed by the bank, so that is money actually deposited in the bank, and they still count that as their own assets that they are managing or whatever. So with less and less credit available, that means that businesses slow down, the hiring slows down, layoffs accelerate, wages decrease. I'm going through that right now myself. My The place where I'm on contract at the moment, my company has told me that they'll renew my contract, but it's going to be with a significant pay decrease. There are a lot of details in this, but it's definitely something that I'm going to feel. So I'm going to renew for the shortest period of time that I can renew, and during that period of time while I'm working through that extension, then I'm going to be looking to see what else is available that would be a better situation. I won't go into bankruptcy or anything, but my income has slowed down, and I'm far from being the only one. Now, some people might think that the tightening of availability of credit will lead to a slowing down of the accumulation of debt, business and personal debt. The opposite is true, because any debt that a person or business takes on is going to be at a more expensive rate of interest. So that debt continues to accumulate, pile up, etc. And this leads straight into an increase in the rate of default on loans. Personal loans, student loans, car loans, mortgages, small business loans, even large business loans. We're going to see more and more of this. So we're going to see more layoffs, slowed hiring, wage stagnation or decline, and increasing debt, while savings continue to deteriorate. What can we do about this? Well, not a whole lot right now. But what is the government going to do about this? Probably going to bail out the banks. They're going to continue bailing out the banks, and just letting people be evicted, go into bankruptcy, have their futures destroyed, their capability to gain future credit at a reasonable interest rate gone. It's just gone. Anyway, so these are just more signs that we are headed we are in a recession. Like it or not, we've been in a recession for years, but now it's headed into depression at this point. Share this video. Talk about these subjects. If you can afford it, please donate whatever you can to help expand this channel and my presidential campaign, and I will catch you in the next one. Thank you for watching. Have a good day.